Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today would be the smartest guy in the room, Mr. Michael Becker from the great state of real estate in Texas with the SPI Advisory Group, but he is not on another due diligence assignment, so we wish Michael Becker the best of luck completing his due diligence walkthrough. In the podcast today, the second smartest guy, the smartest guy that I know, the professor himself. You love him, Mr. James Zhang. James, how are you?
Good. Thanks for having me, Paul.
What's going on in the Old Capital world these days?
Yeah, we just finished up Lunch and Learn last week, and we're having one on December 11th over in Irving. We're switching up the location, so people who are out in Irving, go on to Old Capital Podcast and register for that. I think we're bringing a broker in for that one to just talk about the market, what they're seeing coming up for 2025. And then in January, I'm hoping it's not iced over Dallas, but January 10th, we're doing a bus tour where we're going to see some of the properties we recently closed and financed. And so we're going to have a group of probably about 40, 50 people hop on a bus on Friday, January 10th, and we're going to go see some properties.
If you're thinking about getting into multifamily, whether you're an investor or you want to be a general partner, the first step is kind of know what the heck you're talking about. And so we will try to educate you the best that we can. We put you on a bus. We drive you around to some properties that we've financed. Just like James had said, we'll show you some opportunities about other properties out there and how they've been bought. And then it gives you just kind of an idea how the structure is done and what's going on. So there's a different feel when you're just using an Excel report and trying to pencil this stuff out versus actually walking properties, going inside units, talking with managers, talking with the sales reps. You kind of figure out, again, what this business is all about. And just like Michael Becker says, you cannot start making investments into properties till you go actually leave your desk, leave your office, and go behind your desk and walk out, talk with people, and get to know apartment owners out in the Dallas-Fort Worth area. So we look forward to seeing you at these both events coming up here in December and in January. James, the biggest thing that a lot of people are challenged with today is really managing their properties, managing properties that takes third-party property management. So if you're buying a smaller little property, we've talked to some of the smaller groups that have bought a 12-unit or a 15-unit property or 20-unit property, they can kind of self-manage. But when you start to buy a 75 or 150 or 200-unit building, you bring in professional on-site property management companies to manage your assets. That's what most people do. Some people will try to self-manage those properties, but most people will bring in a third-party vendor to take over their property and be their eyes and ears. We, on our side, on the lending side, we want you not so much to manage your property, but we want you to do two things. Find new opportunities to buy more properties, and two, find money, find equity to buy these deals. So today, I kind of want to talk a little bit about what's going on in property management. And joining me today, his pseudonym, I would say, is Mr. X. And Mr. X works for one of the largest property management companies in the United States. They specialize in the southern part of the United States. They manage lots of properties, 35,000+ units. And he's going to give us a great insight about what's going on today. So, Mr. X, thanks for joining us. We certainly do appreciate that.
Yeah, thanks for having me. I really appreciate this, Paul and James. I've been a long-time listener to the podcast and really think it's incredible, all the value you guys are bringing to your listeners. So thanks for having me on.
So I'm going to kick it over to James, and I'm going to ask a couple questions myself. So, James, what's your question on management companies?
Yeah, at first I thought we were bringing on Elon for a second here, Mr. X, but I guess Elon will maybe come a couple more podcasts under our belt. But no, I appreciate you coming on. I mean, a lot of these deals that people bought in 21 and 22, they ran into higher taxes, higher insurance, and now demand is a little bit softer just because of all the new supply coming on right now. And so, we talked to a lot of ownership groups about maybe one or two properties that they're dealing with. But love to just kick it off to you and just sort of talk about what you guys are experiencing, maybe narrow in on maybe the challenges for an A deal versus a B deal versus a C deal. Maybe let's just start there.
Yeah, that's a great question, James. I think every one of them have a similar challenge today, regardless of asset class, with concessions. We're seeing concessions in the B and C space on a consistent level now for the first time in well over a decade. So, historically, for the last, 6 or 8 years, it's been, a brand new deal is in lease up. You're getting 2 to 4 weeks free. That was really it. That would burn off relatively quickly. Today, you're looking up and seeing, regardless if it's a 1970s built deal or a brand new, you may see 2, 4, 8 weeks free. And so that is a really big challenge. If you're sitting at 4 weeks free, that's about 8% of your income for the year that's just completely evaporated by giving someone free rent. So I think that's the biggest thing that we're seeing right now. And then match that with just affordability. So, we're seeing the A space where there's so much new supply. It varies by where you are in the country, certainly, but in markets that have had a considerable amount of supply added in, they are giving 2 months free. Your effective rent is so much lower now, $300-$400 a month potentially, that you're actually having a renter from maybe the neighboring 1970s deal coming in and moving in because they got 2 months free. They're kind of concession chasing, but over time now you're seeing that as their rent ticks up, they're skipping or being evicted because they can't sustain that rent for that period of time. So certainly, concessions being a big driver, and then overall just the top rent, being able to collect. Collections is the name of the game right now, and really has been for the last couple of years, really since COVID. Collections has been the name of the game, and as the government money had dried up over the last couple of years, you're really seeing the challenges that it is to collect rent, specifically in the workforce space.
Can we talk a little bit about that? Because that, you and I have had dinner recently, and you threw out a statistic in the Class C properties. Tell me a little bit about, pull the curtain back a little bit. What's going on in the Class C properties with collections?
Yeah, that's a great question because, a lot of people think us management companies are all competing against each other, and we certainly are for business, but we are very close and we talk a lot and about what's going on and what we're seeing. And the thing that has been consistent throughout is, especially when you get into the C assets where, an unpopular opinion is now people are starting to call the 70s assets, D asset class. So you're starting to see people shifting there. But what we're seeing is that, 20+% of renters are on a payment plan. You're seeing people wanting to pay rent, but they just can't afford it. So they are having to work out a payment plan. You're seeing the COVID restrictions on evictions that are now becoming an everyday thing. So in more owner or landlord friendly states, you were seeing evictions protocols used to be like a 3-day notice. Today, and through COVID, it was 30 plus days. You're seeing that same 30-day notice applying and really throughout the country. So it's causing people and it's causing property owners to have much higher delinquency and bad debt because people are able to stay longer. You're seeing them not as quick to pay their rent because they're seeing that their neighbor didn't have to pay rent for a couple months before they really had an issue. So they're slow paying. And that's not to be a blanket statement that everyone is that way, but being in property management long enough, you realize that there are people that are truly trying and that have kind of fell on hard times. And you've got another contingent of people that are trying to game the system the best way they can to avoid paying rent.
Maybe we should know this, but let's say you have a bridge loan on a property versus a Fannie or Freddie loan. Does that impact sort of notices for tenants, and sort of give us some detail on that?
Yeah. So agencies now are at, regardless, you have to have 30-day notice before you kick into whatever the precinct or your county rules are around that. Bridge doesn't have the same, but most courts are saying 30 days regardless of the loan type. Something new that we learned this year that we didn't know is we knew that all judges are elected officials. We didn't realize that they don't actually have to be have a law degree. And so why I say that is precinct to precinct, you're seeing the law be handled a different way. So you're seeing some courts saying, here's your 30 days. Now you're getting your writ and you're getting people out within 45, 60 days from when they stop paying. Other places, you're seeing them leg out and give that renter another 30 or 60 days and then making the landlord start over on the process. So they're kind of dictating their rules a little bit, which we found was really interesting because I guess we just always assumed that if they're a judge, they're like an attorney, and that's not necessarily the case.
I know you said payment plan. For some reason, I thought if you receive any payment, that sort of like starts the process over. Is that
Yep, that's right.
not true? Or
No, you're correct. Yeah. When I say those people that are, 20% or so are on a payment plan, we're actively working with them. The markets, the management companies are working with them to collect the rent. At some point, you may have to stop, accepting their payment, turn the payment portal off to be able to run that timeline. And that's what happens if people get off of their payment plan. So maybe they're paying every week.
So it's almost like you're just making a deal from the right from the beginning saying, okay, like, all right, you owe 1,000, but instead of paying it at the beginning of the month, maybe it's 250 a week or whatever it is. And both parties know that going in. And so it works that way, I guess, until they stop paying. Right.
Yeah. Maybe the third or fourth month into their lease, they're saying, hey, I can't pay this. I want to, I need to work something out. The more proactive the resident is, the easier it is for a landlord to work with them because they can understand what's going on. But once they kind of get off of that payment plan, now it starts to become a thing where they've not withheld the original lease agreement, nor now this agreement to work on a payment plan. So at that point, each group is different, but you now are maybe being forced to go ahead and start putting them back into the eviction process.
Yeah. And then going back to on the concession side, and maybe I didn't pay attention to this as much, but like sort of 2015 to 2020, like I don't remember concessions in the BNC space at all.
Yeah.
And now I'm seeing it, you go to any property's website and it's like $500 off and it's a B or C deal or $1,000 off the first month. And so is it just the amount of supply coming online that's sucking up those tenants from B and C up to A? And then, or is it just the amount of demand sort of in the B and C space? Are people doubling up or what are you seeing on that front?
Yeah, I think it's a accumulation of all the things you mentioned. Certainly people trading up into higher asset class right now, while there's such big concessions is one. Two, ownership groups, regardless if you're an individual owner or an institution and you bought in 2022, you're hurting. And so you've got to get your occupancy up to get into another loan. So maybe you're going and offering a bunch of concessions to try to get your occupancy back up. So you're seeing assets that have been very stable, run workforce deals for decades are also in that now concession game because the submarket is. And now that's you've got to play in that space where you just haven't had to before. A good example would be, historically you would see renewals in our business in that 50 to 60% range. In the southern states where you had these incredible 10, 20% lease trade outs for a couple of years, you were still renewing at 55, 58%. Today, renewals percentage is well under 50%, in the low 40s, because you have so many people saying, hey, I'm going to go take this 2 months free, or I'm going to get this 1 month free, especially if people like to move themselves and they're not going to hire renters or movers, then, there's not really much cost for them to make that jump. Where some that may have movers, it's not worth, getting, paying for movers and paying for all the things you need to do to get into a new space. So you may not take that concession, but you start giving it to 8 weeks free. And now you're like, I can pay the movers. I can do all the things I need to do and get a new place. And so I think that's why you're seeing it really start to be so much more widespread.
What does that really mean for landlords? Because there's a difference between physical vacancy and economic vacancy. So physical vacancy, these properties could be at 95%, but economic with all these concessions that kick in could be at 80% or 82%. I mean, can you kind of walk through in your mind with all these concessions and vacancies, like on a class A, B, and C property? I mean, are you giving away the shop on some of these properties?
Yes, certainly you are. Historically, like Class A occupancies, if you let's take a step back and say before 2016, as we had a really strong, upswing for the last, number of years. Prior to that, Class A occupancies were always in that 88 to 92 range. That was kind of where they were underwrote. But the last few years, all of a sudden, they were 94, 95. They were much higher. But the difference was you would never really have a lot of concessions, or you wouldn't have a lot of bad debt there, where you may have your B and C assets, workforce housing being closer to the 93 to 95 physical occupancy, but you're going to have 2 or 3 points of bad debt. So now your economic is getting 88% to 90 on a workforce deal. So you're kind of ending up kind of in the same place economically between an A or a C deal. Today, you're seeing the A space, giving a month free. So you're starting to look at, an economic occupancy in the 85% range, 83% range of economic occupancy. And same for that on the workforce housing deals, if not lower, just because of seeing bad debt. I can look back and see, bad debt at our lowest point was about 50 basis points, essentially, for a portfolio. Today you're looking at 3-4%, just because of what the workforce housing space looks like right now, with just the amount of delinquency out there.
We talked a little bit about dealing with Fannie Mae or some of the bridge lenders, the agency debt versus the non-recourse bridge lenders. What are you seeing from the lenders? Because you guys play such an integral role for the success or the failure of these properties. I mean, are you guys on some of these deals that are having some challenges? Are you involved in the conversations with the sponsor and the lender to kind of figure out what the future is of these properties? And then two, if these properties are doing poorly, are they giving sponsors more time? What are you seeing out there from the lender's perspective?
Yeah, in regards to management, to be honest, we haven't seen a lot of action from the lenders by means of them coming back and taking deals back. About last summer of 23, we signed probably 2 to 3 dozen NDAs with lenders that were looking at their deals, considering it, and we kind of said internally, like, oh, here we go, it's starting. All of a sudden, it just kind of started to die off, and there wasn't a ton of talk about it again. They started working with their sponsors. They started really trying to make these deals work. So we've certainly heard of a handful of deals, going back to the lender, but by large, we haven't really seen that from at least our side. We have seen them really trying to work with the borrower to make sure that they can try to do the best they can. We've seen things even by means over time of also hearing of deals where they are saying, hey, let's pay the vendors. We've talked to the lenders and said, hey, you want out of this deal, the borrower wants out, the vendors are, and we're cut off from the world. The only way we can keep this property going is with cash. And so they foregone the mortgage payment for a few months to pay vendors to get the property back running again. So we have seen a little bit of that, but I think we were very surprised to see how uninvolved the lenders really wanted to be, or how they didn't really want to take these things back, and we just thought that was going to be the opposite of what we've really seen. Is that similar to you all, or have y'all seen something different on your end?
Yeah, we're given, like, we just got a notice on a deal where they're making the payment and the maturity is coming up here in the next 2 weeks. But the lender's like, okay, we had all these conditions for the extension. Don't worry about that stuff. Like, pay us the extension fee, keep making the payment, and go on your way. Because the reality is, nobody expected rates to go up this fast. Nobody thought cap rates would move this fast. And so the lender really doesn't want to take the property back. And a lot of these GPs are doing a good job, on the property. I mean, from the couple things that, that we touched on in terms of occupancy and concessions, I've just seen, when I talk to GPs, they've just been talking about traffic in the office and getting people in the door to do, whether it's advertising or marketing, and then once they're there, getting them to sign a lease. What have you guys seen or done on that front to just sort of separate your properties?
Yeah, we're trying to really work with our groups on, expenses have always been a top priority at our organization. However, you could see the last few years of the run up, people really stopped caring as much about how much their properties were spending, because their incomes were so far more outrageous than what they had ever underwrote. And so you're seeing a big focus back on the expense side, which we've been really happy to kind of always been focused on that front. So when groups are talking about how do we need to save money, what can we do? We've really tried to push back on like it's not in payroll and it's not in marketing. Like we really need to find other places. Those are usually the first two in an underwriting that get clipped. But there really is proof that, if you pay good, you have good marketing, people will come in, people are going to stay, and having a really excited team on site is really critical. So making sure that they're well taken care of really can help make up for, other things that are off because their ability to kind of take care of the residents and they're upbeat about what's going on at the property.
Talk to me a little bit about fraud. So at the Old Capitol conference that we held last month, we had a group of property asset managers and third-party managers kind of talk a little bit about the growing concern about tenant fraud. And one of the asset managers said that they're getting like 16% of their leases in their area were fraud. They had some reason of fraud. That I guess you pay $47 and you go online and you kind of create your own person, your own application, your own W-2s, your own 1099s, get somebody to verify your income, supposedly, and then you can fool the landlord and move into the property. It's just wackiness these days. They brought up AI to try to sort some of that stuff out and make sure it's happening. What are you seeing with fraud out there, Mr. X?
Yeah, I'd love to tell you that's not right, but it certainly is. You really are. It is the number one focus on site when the team is getting the required documents to get someone approved, and it is now taking at times a little bit longer to get someone approved because you're having to pay for more systems, you're having to use some AI features and do things to really scour, crawl the web, with these systems to figure out like, did this person work there? Was it on LinkedIn? Like, where can they try to verify that this existed? Because it is so big. And if you scroll TikTok or Instagram and you can see where people are like, hey, do you need a new apartment? Like, here's what you do. And they kind of walk you through how to like do exactly this. And it's funny to joke about years ago about like, you could just get an apartment under someone's name and, but now you're seeing people really try to do that. It's really scary to see how easy that's become. Fortunately, there are a lot of systems that are getting put in place, but it's definitely been retroactively. It's not something that people were really ready for when it all happened.
Is that all in all classes, or is it just in C class, or what is it?
It's really all classes. Certainly you're seeing it a little bit more in your heavy workforce housing and maybe people that have had some bumps in their credit history, but it's really kind of all over.
Yeah, I mean, sort of how we started this conversation around Elon and, anything you see on Twitter or X, you don't know if it's real, right? Like, I mean, you can strip the voice off of this podcast and make Paul or I say anything, right?
Yeah.
You can create think about, making a PDF, a pay stub to show is not that much harder, right?
Yeah.
And I think COVID sort of accelerated the whole fraud piece just because a lot of stuff went online versus before someone literally had to come into the office and shake that person's hand and, agree to do all this stuff. And you had their picture and everything like that.
Now you can do property tours online.
Yeah, property tours you do virtually. And then, I mean, some of these large Class A properties, the CEO of Camden, which manages, I don't know, 50 or 60,000 units, even on his call, he was like, yeah, I got a call saying, are you leasing one of our units? And the CEO was like, nope, that's not me, because it was in the wrong city. So talk about sort of your interaction. You guys manage some stuff for your own book, but then also manage stuff for third parties. What is your rhythm with general partners, and what have you seen sort of best practices on working, that person's responsible and reporting out to investors, and you guys are responsible for really the property and communicating that back to the general partner. How have you seen like sort of the best general partners interact over the last couple of years?
I mean, how much time do we have? Yeah.
Just the highlights.
Yeah.
So maybe give me like 2 examples of good stuff that they do, and then maybe a couple on stuff that maybe you shouldn't do that.
Yeah, absolutely. I think, one thing about it is property management, I think people view as a commodity business. And the truth is there probably are no two companies alike, whether it be what the support functions and what all they do. So sometimes you say, hey, ownership groups that can take a step back and let the team, let the management company run the day-to-day, run the operations. May not work for all, because maybe some management companies just aren't built for that and they need the ownership to be way more hands-on and so forth. But what we found to be the most successful is ownership that focuses on the asset management decisions of the business. So that's cash flow, your investor returns, the business plan, overall what we're doing today in 2024. Is that work for 2026? Or are we getting behind or ahead? How does that look? Those are things I think at times that people believe that is the management company's job. And it's really not the manager's job to understand what your pref equity position is. Like, when does your rate cap expire? And you would be surprised at the amount of times that we talk to groups that are frustrated with their management company, and what they're telling you are really things where you're like, well, this would really be like an owner, an owner.
It's an owner decision.
Asset,
you guys should be tracking that, right?
Right. We need to be focused. So then but on the reverse, they'll be so overly involved in the day to day and really trying to build relationships with the on-site teams and those things that then the business plan's not being moved forward at the site level, because they're so focused on also being there, but then they're not focusing on the section of the business that they really should be. So I think that's one of the challenges that we work with groups on. And I think even talking to them about is, hey, if we have a regional supervisor with 50 hours a week that they work, call it 40 to 50, and they have 5 or 6 assets, that puts them around 5 or 6 hours a property a week. It doesn't always work out to perfect math like that, but the more hours they spent doing reporting and doing these various tasks takes away from moving the business plan forward with the site team. So let's keep that communication. Let's get really good, consistent communication and a process that works for both sides, because the goal is for us to move the asset forward with the on-site tasks, while our ownership groups are focused on, sourcing capital, making sure the deal's flowing right with the lender and so forth.
Do you think like a weekly call is sufficient? Sort of once a property is stabilized, maybe after a year, maybe that first year is a little heavier, but after a year, deals sort of stabilized, like a weekly call with the GP is pretty standard for you guys?
Yeah, absolutely. Yeah. Once a week is a great call. Even when the deal's going great, I think once a week call is a great touch point. Some groups will start, they'll want multiple in a week, and then all of a sudden they'll just stop them all together. And we say, no, we still think good, consistent communication is critical. But yeah, making sure that we kind of get it to a certain period of time and we figure out what metrics they need to see. And then how can we help them find those metrics in the system or in the business intelligence AI reporting that's done? Like, can that give them enough comfort to have that? Or is there a bunch of manual reporting they're going to want people to do every single week? Because if it takes 4 or 5 hours a week for an on-site manager to prepare all the manual reporting, we've lost 10+% of their work week just on getting the owner some of their reporting. So making sure groups are working with management companies that are utilizing technology, that are doing things to help keep the site teams focused on the site activities is also, a big help to helping them, the owners, then get comfortable with all the data they're getting back.
When the owner goes on the site, on the property, what's some best practices there? I have a couple ideas, but I want to hear what you think.
Yeah, I think it's certainly being courteous to everyone that's out there. Also, don't let any of the residents know that you're the owner. I think is one thing that we always say is, you don't ever want anyone to know who's the owner. But really,
it's always some random. It's always some random guy in New York, right?
yeah, exactly. But you know what? Paying attention to things. We like to look in. Have them. Go through the model. How's the model look? Follow the tour path. Have the leasing agent take you on a tour of the property the same way you would a leasing agent. How does the property look from that perspective? Is the team well dressed? Are they? Do they look like they haven't been out from a late night? The night before. Is it presenting a good product well? Are really the big things that we ask our owners, or that we see the successful ones do when they come out to a property, is really just feel what it's like to be there, and just kind of making sure that it feels like it picked up and it's well kept and seems seemingly in good order.
Yeah, I mean, some small stuff I usually have them do is really, if you don't even know who's working on site, right? Like, because everybody's just dressed how they came in from last night, just came straight into the office. Like, that's probably not a good move. And then, one of the metrics I have people track is really just sort of like the days on market for some of these vacant units. Sort of drives me crazy when a unit's been sitting for like 180 days. It's like, what the hell's going on in this unit? Like, we got to move this thing. But any other metrics that you guys track sort of at a high level?
Yeah, so we're looking at, lease trade outs, days vacant. Are we seeing a particular floor plan type, building, things like that are harder to lease so that we take those into consideration. Lease expiration schedule is huge as we talk about future rents and what's going on. Also, seasonality. This is last year we had seasonality in the winter for most of the country by means of slower traffic. There was about a 4-year, the COVID years there where the winter was just as busy as the summer months. And so that's partially why we were able to maintain these high occupancies across the nation. But last year was the first time we had seasonality since 2019, and we're seeing that again right now. So looking at lease expiration schedules, looking at the trend, we focus a lot in the management side. We focus more on trend than we do what are we physically today or what are we leased, right? Because we know where we are, but we need to know where we're headed and what do we need to do in the next 30, 60, 90 days to make sure that whatever that trend is doesn't actually happen. Because usually the trend is 3 or 4 points below what the actual physical is.
So we've talked about the challenges with the tenants, and we've talked a little bit about the challenges with the sponsors, the general partners. Let's talk a little bit about what's going on with some of the vendors that support the business. And the vendors are the painting contractors, or the vendors are the ones that put in the carpeting or the flooring. It's been challenging for the last couple of years because there's been so much business that they've kind of priced themselves up and up and up. But now what's going on in the market these days, Todd, with some of these vendors?
Yeah, sadly, you're seeing some of these vendors, shut down and, close their doors. You're seeing it with contractors as well as, material distributors, and it's really because of, partially maybe losing their labor, but mostly it's because of their accounts receivable has gone wide on them and they haven't been able to recover. Especially groups that are working on big CapEx projects with lender draws and some of these things. They are waiting for 90, 180 days for payment. And over time, they're just not been able to continue to hold out on that money to come in. So you're starting to see some of these AR balances getting bought off. You're seeing vendors shut down, which is really sad to see. But as owners legally have to prioritize their mortgage over the vendors, that's keeping vendors from getting paid, as well as the DSCR scores dropping so low that in some cases they're not able to even get draws from the lenders to pay some of these. So it's leaving these vendors kind of stuck out there. So you're seeing a big consolidation right now of some of these smaller organizations. If you look at it, from like a material distributors and multifamily today, like HD Supply and Lowe's have bought a majority of the market share across the country. Same with flooring. There's just a few flooring providers that really provide majority of the flooring for the entire nation for multifamily. So you're starting to see some of this roll up into just a handful of groups. So pricing has not really dropped yet. You're seeing better service, and you're seeing, on the contractor side, groups more willing to do jobs they weren't before because they need to keep their crews busy. But we just haven't seen a lot of pricing adjustments from the downside, but we're happy that it's stopped going up. I think, Paul, we had talked about this a couple of years ago. You would bring on a new deal from maybe a one-off management company that had 5 properties, and you would call that vendor to say, hey, we'd like to use the landscaping services, and they'd take the price up 20%. You'd say, well, look at our portfolio. We have a lot of opportunity here. And they're like, well, we're losing money on this property currently, so we don't care if you stay with us or don't, but the price is going up 20%. And we just, we were not ready for that. You couldn't imagine that, a local manager or a local landscaper wouldn't be willing to take on a 40,000 unit portfolio. They're willing to sacrifice the deal there, the contract, because they were losing. So happy that at least the pricing's not going up any further.
You look at tens of thousands of apartment units, deal with hundreds of owners that own these properties. You guys create financial statements. You look at all the income that's coming in, all the expenses going on a per property basis. Are apartment owners making money these days? And where's the opportunity to make money these days? What are you seeing these days, Mr. X?
Yeah, it seems as if people are really kind of just hanging on. The survive to 25 was a real thing. And it seems like we're going to need to keep hanging on through 25 to get to 2026. So, certainly people in fixed rate debt and that have had long-term deals, especially in markets that maybe aren't facing the same real estate taxes or insurance as some of the markets like in Texas that has really high property taxes, as well as insurance. Those are really eating up and eroding a lot of the increases to income you've seen over the last few years. So it is very much a challenge right now. We're seeing a number of groups, by popular or unpopular opinion, it depends on who you talk to, the HFCs and PFCs becoming a really big focus point right now to limit your real estate taxes in Texas, which is helping people get to a positive cash flow position. But it's certainly a tough environment right now where people are really focusing, and as we talk to groups looking at deals, is they're really trying to get back to fundamentals, and it's less about asset class and more the market, the submarket, the school district, the crime scores, the police presence. Like, where do people want to be in any market? It's where there's good schools and things like that, good business front. So, we always like to tell people, you probably went to a better school than where your parents went to school. Everyone's always trying to move up in class, right? So the places with good school districts tend to always have the best apartments, the best renters, the best rents, because they're attracted to the schools and everything that bring that. So that's where we see a lot of people focusing right now.
Talk to me a little bit about back 10 years ago, 5 years ago, we talked about value-added properties. Sticking $3,000 onto a Class C property, you could raise rents by $150, $200. Are you seeing a lot of deep value properties, people that are acquiring? Are you seeing mostly just stabilized properties? In fact, what does it cost to do a value-added property? What's that $3,000 gone to for just a minimal update to the property?
Yeah, it really changed a lot. And that's the conversations we're having right now as we look at, like you said, some of these value add deals, or what would be perceived value add is there really the delta in rents to go and get that rent right now? And I think most people are saying, hey, we think it's going to be there later. Right now, let's buy this deal. Let's let the next 12 months, let's operate it as it is. Maybe we do a couple of units. And if we can do it early, that's great. We're getting ahead of our business plan, but knowing that, hey, maybe through 2025, we're not going to renovate as much, and we're going to really keep it kind of operating as it is and try to find some low-hanging fruit through some added revenue streams like bulk internet and some of those ideas. Because yeah, you're right, your costs have materially gone up. I think one good example is 2018, you're buying a black appliance package for $1,400. That's fully in with the microwave, the ice maker, everything, all the parts that you need for your appliance package. Today, that same appliance package is over $2,000. So you talk about your $3,000 spend, you flip out to a black appliance package or maybe a stainless one for $2,100 to $2,300. I mean, you've eroded most of that $3,000 with just an appliance package right there.
So how do property owners get fired today by their property management company? Or why won't you take on an assignment?
Yeah, I think the biggest driver for client termination today, as we talk to a number of management companies, is really based on capital, not having enough to pay their bills. Fun fact, vendors don't view owners as the owner of the property. They view the management company as the owner. So if your company is not paying the bill, they don't think about that owner not having the money. They're saying that management company is a problem. Now you get a bad reputation. That really hurts you when you go into renegotiating your contracts because you're known as a slow payer. And the vendors, they all talk. So they know who's paying, who's not paying, and what's going on. So that's the biggest piece is once you don't have the money to pay your bills, the residents get upset because they don't know that you're not paying your bills, but your work orders are slower. The site team is fielding more calls from vendors upset, getting very unprofessional about where's my money. So the site team gets disgruntled. So it's kind of this snowball effect. But at the same time, we see that, and you'll look at groups that get terminated from their management company with a 7-figure number of outstanding payables, over $1 million. And there will always be some company willing to take it But certainly termination by lack of cash is the number one reason you'll see. And then the second biggest reason is really involvement from ownership, maybe being overly involved in areas that they shouldn't be, and then maybe not as involved in other areas that they should. I joke with, we get calls saying, my management company is the worst we've ever had. Like, they never told us we were running out of cash. They never told us that we had all these payables. So we'd say, well, can you send us some of your financial statements and some of these things? And we would go back and look, and we would see in the statements that they have their payables in there. They have a cash flow statement and all these things that are showing them that they don't have any money and it's all going out the door. But they're saying, well, they never told us. And so I think that's one of an aha moment for us a few years ago, that not enough of the GPs out there necessarily like really maybe dig into their financials as much as you would think so.
Or the one that you were talking about before gets a chuckle with me, where you have had an owner where you needed to buy a refrigerator, and the refrigerator was like $550 or so, but the owner found a refrigerator online for $480 and wants to know, why can't you buy this refrigerator at $480? Just a one-off refrigerator at $480. And they want to get into your business, and you're way too much in our business, and thank you very much, and then goodbye. So you got to let the professionals be who the professionals are. I mean, when they're buying these they're not staring at the Lowe's or the Home Depot ads every freaking day. They have contracts with some of the biggest supplying companies out there, and they're just not buying one-off refrigerators. They're buying hundreds of refrigerators or so, and that's what the price is for that, whatever's going on. Any comments about the overactive owner that wants to get into your business?
Yeah, I think the same thing too. As I think about, put my owner hat on, it's like, oh, we could save money right there. Why are we not doing that? And then when I put the management hat on and getting the decades worth of experience on the management front, is you see when you do that, what falls through the cracks when that happens. So we saved $70, but our maintenance guy had to go pick that up for 4 hours. So we lost, 6 work orders. So it's kind of this like trickle down effect of like, you don't see what you don't, we don't know what we don't know. And so I think that's where you see that, is they want to really get involved in the day-to-day and how something works. I think what's fascinating, we're the only industry that I know of where the team on site is an employee of the management company. They are on their workers' comp. If there's a problem, the management company is being sued, not the owner. But however, the owner is the one paying the wage, the salary, back to the management company. So there's sometimes this disconnect on like the owner of the property thinks that that's their team, and the on-site team doesn't necessarily agree to that or feel that. And so that's where it's kind of like we try to keep the management company forward facing to the site team and let the ownership talk to the corporate or the regional support team, and then let that team handle all the communication on site, because too many times you're getting difference of opinions or different feedback with how you're doing. I had to slap a good friend of mine's hand one time because he kept talking about how great the team was, and he was taking them lunch. And then he didn't know that this same manager had just been written up and was pending a termination, but he's out there telling her how amazing she is, not knowing all the things she's not doing in the back end that we're having to make up for. And so she's getting, it makes it a very toxic environment, right? For everyone. Like that person can't figure out, are they doing good or are they not doing good? Because they're getting it from both sides. So definitely telling them, like, let us handle the on-site team. You don't need to be their friend. You don't need that. Like, let us keep that professional relationship going, and property will perform at a higher level than having so many people involved day to day.
So finishing up the conversation here, and I'll turn it over to James for maybe a final question, but Mr. X, what is something that new investors or new people that want to buy properties, what should they know that we really didn't talk about today? What is something that you think that should resonate with people that they should think about besides all the things we talked about? What else did we miss?
I think staying engaged in what's going on in the market. Listen to your management companies, what they are saying about the market, but doing your research, understanding it, knowing when you look at market data, who's the writer of the data? Is it a mortgage banker? Is it investment sales? Like, what's their end game, right? To be able to know the data. Too many times you hear from groups or owners that that read an article about South Florida and they're talking about a deal in Colorado. And they're like, well, look at these rents. And you're like, well, that's like 5 states over. That's a totally different. So I think knowing what's going on in your market, even though you have a management company, is very important, as well as being ready to make changes. Your business plan is not going to go to plan. What over a 5 or 10 year horizon, like there's going to be some market changes that happen. And so, in a time right now where your 2024 market rents were supposed to go up 6%, but all of your comps have 6 weeks free, you can't push your rent 6%. You've got to adjust. You got to find a way. There's going to be times to make our money, and there's going to be times where we just kind of got to hang on. So kind of being ready to understand and ride the wave of a strong real estate cycle.
Great information, Mr. X. James, the professor, any more questions?
The only question I had real quick is, and somebody asked me this and I didn't know how to answer it, so I'm going to just ask you. When you're putting aside money at the beginning of a deal, how do you determine how much should go in the operating account for you as a GP into the operating account for that property? Is there like a rule of thumb there that I have an idea, but I'll just throw it over to you, see what you think.
Yeah, we've always said 1 month of operating expenses at a minimum. If you take taxes and insurance out, because those are being escrowed, somewhere between 1 to 2 months is what you really need in your operating account day one. Assuming you have a capital account that is not only for CapEx projects, but some reserve cash as well. So I think that would be one of the challenges we see is groups will just say, well, we're not going to pay our mortgage payment this month, so we'll use that as like the starting cash. But you may really want a couple months worth of operating expenses in there with a little bit of cushion, knowing that something's going to come up. There's going to be an HVAC that breaks. There's just going to be something. So yeah, I'd love to hear what what your rule of thumb is.
No, I would say that or more. So I was thinking
you
like
can't have
a month. Yeah, a month of, and honestly, the guys who, like you mentioned it earlier, you said, all right, fixed rate debt, those guys aren't really stressing right now. But the guys who, I'm not going to say over-raised, because this is probably the right amount of money to have, is they didn't just raise 1 month. They've got 6 months or 12 months sort of in operating, just in case, occupancy does slip to 85 or, lower. You have the money to fix these units and bring it back to 90, 95 versus like being so short that you stop making payments to people.
Yeah, certainly. I think that thinking of it that way, you certainly need more like you're saying. We do a weekly cash analysis for our entire portfolio and looking at burn rate and figuring out where do we stand amongst a portfolio? How many more months at this collection does this property survive? And so we have levels of severity. And so those conversations start with ownership groups, 4 or 5 months before, in most cases, before they really need the money, unless something catastrophic comes up. But kind of like a rate cap where we're unaware of like the actual expiration date. And we thought we had 4 or 5 months worth of cash. And then all of a sudden we got $1 million rate cap. We're like, well, you're going to need more money now. So yeah, certainly, like you said, far more than probably what I originally gave you.
Well, Mr. X, we've come to the end of our road, and we certainly do appreciate spending some time with us and having us kind of more understand what's going on in the lives of folks that really manage the properties, because the role that you play is such a critical role for profitability or not profitability. If you're going to spend money, you want to spend it on the best property management company that you can find out there, and the best property manager that's going to keep an eye on your property. So some people want to do it themselves. At this level, you want to have somebody that is really in the game, sees what all the vendors are charging for appliances, paint, carpet. There's a savings of the commodity in bulk that you get when you deal with the property management company of size. And then you're always being told about really, hopefully, what's going on your asset too. So, Mr. X, thanks very much for spending some time with us. We certainly do appreciate it. James, always a pleasure. Thank you very much. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.